Good morning, Dan. Well, indeed, I mean, what's been happening in oil markets, just as other markets since the beginning of August, has been more like a roller coaster and far from the quiet months that many would have hoped for. So you do have the overall kind of uncertainty that is affecting various markets, particularly the economic outlook. So far, we have been focused on China because the Chinese economy has disappointed and has revealed some structural problems, but also increasingly, some are allocating a greater probability of a recession for the US economy, which is perhaps much more dangerous to the health of the global economy given its size. I mean, it's not the likeliest scenario, but people are more concerned about this. Now, so that has kind of created this kind of volatility that we saw in oil markets, among others. But in oil market in particular, there has been the developments on the geopolitical front with the potential of a ceasefire in the Middle East, which kind of dissipated the fear of a major escalation, especially between Iran and Israel, and potential supply disruptions. So that by itself weighed pretty heavily on concerns about oil markets, and that fear has dissipated to a certain degree. I don't want to say with great certainty that it's not going to happen at all, because you don't know what that can still happen between Iran and Israel, and the deal has not been sealed yet, the ceasefire deal. But so far, no supply disruptions, no fear of such supply disruptions at the moment, plentiful of spare capacity and weaker demand from the economic perspective. This gives us the prices that we are seeing today.
Nevertheless, traders also monitoring the news flow out of the Middle East. And Carole, when you look at the scenario and the situation on the ground there, do you think an Israel-Hamas ceasefire deal would necessarily be a game changer for oil prices, for inflation, for interest rates as well?
By itself, I mean, it's never one factor that will determine the direction of oil prices. We are seeing different forces pulling the market in opposite directions. You do have the concerns about the demand, and we saw in its latest oil market report, OPEC kind of confirmed concerns about demand growth for this year, those who were really worried about seeing a weakness in demand growth. And although the downward revision was small, but still it was a major change in OPEC's position vis-a-vis oil demand growth for this year. On the supply side, outside OPEC Plus, the supply growth remains robust, led by the US. But even within OPEC, we are still seeing countries overproducing. So this is what I would say traders and market observers are taking into consideration. If there is a ceasefire between Israel and Gaza, I think the potential of Iran and Israel attacking each other kind of weakened, because I'm not sure what Iran would gain from further escalating or kind of reversing a major progress in the region. We cannot rule it out, but at the moment the risk is low. And of course, if there is a ceasefire, that would be a plus for consumers around the world and for the Middle East in particular.
Indeed. And what's also interesting, Carole, and you highlighted this, is that OPEC is no doubt watching these headlines as well. And you also flagged that we saw both OPEC and the IEA revising down the 2024 global demand forecast based on primarily concerns out of China, but of course other issues at play as well. How do you think OPEC would respond to a potential ceasefire deal, for example? And are further downward revisions to the growth outlook coming, given the current macroeconomic state of play?
OPEC in its market outlook, the one that they published in August, kind of confirmed that their downward revisions to oil demand were driven primarily by the economic uncertainty, and those uncertainties have not dissipated. That said, the downward revisions have been very small, like 135,000 barrels a day, if I got the number right, and they are still the most ambitious and the most sanguine, if you want, in terms of oil demand forecast for this year, and well above around 1 million barrels a day difference with what the IEA is expecting. Now, we're going to watch and see whether there will be further downward revisions to their outlook in the coming months. That said, they do acknowledge that we are heading towards the hurricane season, and that could disrupt some supplies from the US, and that could justify the increase in some of their voluntary cuts, which they decided upon for the remainder of this year and more for next year, 2025. That decision is not cast in stone. And if prices go below, let's say, the $75, $80 range, then they may want to reconsider it. But there are so many factors and moving parts at the moment that would indicate that maybe OPEC can still continue its decision, but it's a big risk they are taking if demand growth is not further supported.